For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the retirement squeeze, inflation, war, and market risks colliding. Are you a Midwestern millionaire? We'll talk about the hidden challenges of having enough. Also, ways to generate income in retirement, which is right for you. And then finally, 5 things that people wish they knew before they retired. My name is Jeff Shade. As always, I am just here to ask the questions. But the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Hey, Jake, how you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else is having a great weekend. It's the first weekend of April. April showers bring May flowers. Spring is just right around the corner. We certainly are glad you decided to include us in your weekend. Well, Jake, right now we're in what I'd call the perfect storm for retirees: rising inflation, geopolitical tension, and uncertainty around interest rates. For someone nearing or in retirement, Jake, it feels like everything is hitting us all at once here. Is that a fair way to look at it, do you think?
I think that to look at it that way ignores the last 3 years or so that's been pretty good growth-wise. For the most part, unless you have invested a whole bunch of money very recently, you are up, and you're probably up a lot on your investments. And so when we look at the market, which at its lowest point here was down a little less than 10%, I mean, that's a big number, and we don't like losing money, but stocks fluctuate, and it's important to zoom out on your chart occasionally and go, okay, yes, in the last few weeks it's been difficult, and maybe even the last few years it's been difficult from an inflation standpoint. But if we zoom out on the chart, most of the people listening to this show that are getting close to retirement have had money invested since the 1980s.
Yeah.
Which means you're probably up 10x on your investment, what you actually put in. Maybe if you got a couple $100,000, you probably put in 20 or 30,000 in the 80s and 90s, and that's how you ended up with it. So it's important to give a fair shake to your investments and not just focus on all the negative that's come in the last few weeks.
Jake, let's talk about what's driving a lot of this stuff. Oil prices spiking due to the Middle East conflict. How does something happening halfway around the world end up affecting someone retired right here in Missouri?
Yeah, I think this is a question a lot of people have, and especially when it comes to the price of oil, people are like, hey, we got plenty of oil here at home. Why is this affecting us at all? And the answer is oil is a global commodity, and so it's priced based on supply and demand all around the world. Here in the U.S., we use what's called WTI crude or West Texas crude. And, it's in the $100 or so range. Over in Europe, they use Brent ice crude is what they call it. And so it's $110, $115 a barrel. And then over in the UAE and Saudi Arabia, their oil, they're paying like $150, $160 a barrel over there. The answer is it doesn't really affect us except from a cost standpoint on the global market. And global companies pay global prices for fuel. And if fuel goes up, input costs go up, profits go down, stocks go down. As I've said in the last couple of weeks here, the only thing that really matters here is the price of oil. And if the price of oil comes back down, we will see stocks go back up just as quickly as they came back. But we do need to put an end to this. Now, I also think that it's worth mentioning that President Trump has a gigantic axe to grind here in getting this war settled like yesterday. If he does not, if he lets this go on a couple of months, it will probably cost us the midterms.
Right.
If it costs us the midterms, they will impeach him almost immediately, and they will attempt to remove him. Whether or not they have enough votes for that remains to be seen. So he has as much skin in the game here as anybody. And so I don't believe, unless you believe he's an idiot, then you have to believe that he plans to put this to bed pretty quick. And I think if he does, he will come out of this looking like a hero. If he is able to create peace in the Middle East in a way that we haven't seen, grease the wheels of business and interaction, pad corporate profits, take the stock market up another notch, again, he's going to look like a hero, and it's going to help us in the midterms. And overall, I think that's a good thing. But we have to be a little bit patient here. It's not as simple as, hey, let's just make this happen.
Right.
But I do think that defending what he has done here so far, he really didn't have a choice. We can't allow Iran to have a nuclear weapon under any circumstances. I mean, there is no room for argument there at all, period, the end. I mean, these people want us all dead, and you cannot allow them to have the means to make that happen. So regardless of oil prices or anything else, he had to do what he had to do to defend America. And so I will not apologize for that. I don't think he'll apologize for that. And we may have to ride out a little bit of choppy market here, but things got pretty oversold. We started to see a bounce here. We'll see what happens over the next few days. But I mean, this thing could be over at any moment.
Jake, I would completely agree with you. I would be willing to pay $4, $5, $6, $7 a gallon for gasoline if it meant that I wasn't going to be nuked. Talking with Jake Floyd Financial Group, we're talking about the international situation, how it affects us right here in Missouri. And to your point about oil, oil impacts everything, not only gasoline, but also the cost of food because of transportation costs and utilities and insurance. And all of those are so important to us here in the Midwest. We're also seeing the market struggle just a little bit, especially smaller companies. Why is this such a big deal for someone just entering retirement?
Yeah, timing can be a really big issue when it comes to retirement. Most people are not worried about timing the market. And if you've been invested over the last 40 years, you haven't really been too worried about it because you know time is on your side. And even during 2008, when things got rough, things came back tenfold afterwards. So when you go to retire, you're a little bit at the mercy of your timing, the sequence of returns risk, as we've talked about many times on this show. If the first 2 or 3 years of retirement are bad years, it can really negatively affect the performance of your portfolio. We need to be careful when we're constructing a portfolio that we make sure that we have some protection in place on at least some of the money, because you've done all the hard work at this point. You have your money accumulated. What we need to do now is not mess it up. And in order to not mess it up, what we need to do is not have a 50% loss or something like we did in 2008, right? And how do we protect against that? The majority of what I spend my time working on here when I'm managing investments is how can we manage to where we don't have huge losses, but we still get the lion's share of the gain? And really, at the end of the day, that comes with having a plan, having a few different buckets of money that perform differently, and making sure that we're still getting paid, but we need to take the worst case scenario off the table, because once you start withdrawing money out of your money, we really can't afford to have a 20, 30, 40% loss.
Jake, you talked about having a plan. Can you design a plan that mitigates the risks of sequence of return? Is that even possible?
It is to an extent, Jeff, because if we have a portion of money that cannot go down under any circumstances, let's say we have half the money in the market, we have half the money somewhere where it cannot lose. Now a 50% loss is a 25% loss, right? Or a 30% loss is a 15% loss. A 15% loss we can recover from, and we can get back to even. The problem is when you start withdrawing money out of your portfolio, it becomes more difficult to get back to even from any loss that you have. And that's really the biggest thing, is we have to be able to get back up, because the portfolio is going to move around a little bit, especially if you're in the market. There's going to be years where you're down. There's going to be a lot of years where you're up too. The market's up about 73% of the years on average. So that's a pretty good batting average, but we need to have some protections in place, whether it's bonds or annuities or cash products, whatever it is. And we can talk about that when you come in for your consultation, but we need to have something that will protect us against some of these geopolitical risks or the black swan events like the financial crisis or COVID or whatever these things are that we can't see coming, because we don't want to just be at the mercy of what the market does to us.
Talking with Jake Floyd of Floyd Financial Group, and we're talking about current events and how the effect is right here in Springfield, Missouri. And again, Jake talked about having that consultation with him. If you would like one of those, the Floyd Financial Group Retirement Review at no cost and no obligation, call 417-889-7233. It's 417-889-7233. Leave your name, telephone number. Ashley will give you a call back and set up that appointment. Once again, it's not going to cost you a dime. And that number, 417-889-7233. Jake, let's talk about interest rates and bonds. For years, people complained that they couldn't earn anything safely. Now rates are higher, but there's still confusion. What should retirees understand about bonds and interest rates right now?
Yeah, so for the last, let's say, 20 years or so, bonds have not performed very well. And a lot of the reason for that is interest rates were perpetually low. And then in 2022, when interest rates came back up, that hurt bonds that already existed. So over the last 20 years, if you look at bond returns, it's 2% or something, depending on what group of bonds you're looking at. However, all that carnage in bonds creates opportunity. If we had real estate in this area that went down 70% or something, that would be bad for people that own real estate, but for people who had cash to put to work, that would be the buying opportunity of a lifetime. So the same is true in the stock market, the same is true in the bond market. And so what has been the headwind for bonds over the last 20 years or so is now the tailwind, because I believe that interest rates are going to be coming down in a big way. That doesn't mean it for sure has to happen, but based on the signs that I see and based on experience and an educated guess, I think interest rates will come down in a big way. And so people that own bonds now, while interest rates come down, will get the appreciation of those bonds. So you will make money beyond the interest that you collect. I like bonds here. We have to be a little careful what type of bonds we end up with here. And I'd be careful with some of the global bonds, given what's going on around the world, obviously. But domestic high-quality bonds, I think, could be a good investment over the next, let's say a couple of years for sure. And then we'll have to kind of play it by ear from there.
Jake, every week we touch on inflation, and retirees feel inflation a bit differently than what the government reports. Can you explain how that works?
Well, the government numbers are full of crap.
Okay.
That's really probably the number one thing. As you're probably aware, if you've been breathing air over the last 6 years or so, the government seems to think that prices are up about 30%. I dare you to name one thing that is only up 30% since 2020.
Yeah.
I mean, there's almost nothing. I mean, most stuff is double. Some stuff's triple or quadruple. The cost of food is astronomically higher. The dollar value menu at different restaurants is definitely a thing of the past. It's now the $5 menu. And I mean, I remember in college, so this has been a few years ago now, but let's say 18, 19 years ago, I remember we used to go to Wendy's and we'd get 5 double-stacked cheeseburgers for $5.
Yeah.
And as a poor college student, I would just go and get 2 of those deals, and I'd just stick them in the fridge and heat them up when I was hungry.
Sure.
And that was a relatively high-protein, low-cost meal. Arby's did something similar where they'd do their beef and cheddar back in the day, 5 for $5.
Yeah.
Now they're each $5 at least. And I think that we're definitely experiencing more inflation than what the government would have us believe inflation is doing. I mean, I think another thing that's very obvious is rent, housing costs, but definitely rent specifically. It's very difficult to find a 1-bedroom apartment under $1,000 in today's world, which is just crazy. It wasn't that long ago that you could have one for $500.
Sure.
And now some of these new facilities that have pickleball and a coffee shop in them, it's $1,500 for a 1-bedroom apartment.
Easy.
In Springfield, Missouri, that's the part that's crazy. In San Francisco, it's one thing, but here, you got 500 square foot studio or something, and it's $1,500 a month. It's just, young people are the ones suffering the most from this, but as you said, it started to eat into retirees' spending ability, and we have to be cognizant of the fact that it's going to take more money to live 15 or 20 years from now than it does today. I do not think that inflation will persist the way it has been over the last 5 or 6 years. I think a lot of that was catching up from a period where we had very low or no inflation through the late 2000s and 2010s due to the fact that interest rates were perpetually low and that kind of thing. But yeah, inflation's a real thing, and we need to make sure we're prepared.
Jake, I want to take just a moment here to talk to our listeners. No one knows what oil prices will do next, and no one knows what the Fed will do next. No one knows how long this geopolitical tension is going to last, but one thing you can know is this: whether your retirement plan can handle it. If inflation stays high, if markets stay volatile, if interest rates stay elevated, will your income hold up? Will your portfolio protect you? Will your plan actually work in this geopolitical environment? Well, that's why Jake and the team at Floyd Financial Group are offering a complimentary retirement review to help you understand exactly where you stand right now. To get yours, call 417-889-7233, 417-889-7233. You can also visit floydfinancialgroup.com. Don't wait for the next headline to make the decision for you. Get a plan that's built to handle all of this. Jake, it's time for a break here on Show Me the Money. When we come back, we're going to be talking about Midwestern Millionaires, the hidden challenges of having enough, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about, are you a Midwestern millionaire, and the hidden challenges of having enough.
And Jake, Springfield may sit on the edge of the Midwest, the Ozarks, but the mindset here is, I think, pure Midwestern. We're hard-working, disciplined savers who've done the right things financially. And we're talking about a group of people that I think describes a lot of our listeners, folks who've worked hard, saved diligently, maybe have $1 million, more or less, but still don't feel confident about retirement. You call them Midwestern millionaires. To you, what does that mean, Jake?
Well, being a millionaire in California is different than being a millionaire in the Midwest. And most people in this area that are millionaires, there are some people that have $1 million, but a lot of them have land, or they have cattle, or they have other assets, house, maybe rental properties or something. And a millionaire is somebody with a net worth of $1 million, not $1 million in the bank, right? And I think that a lot of people view a millionaire as, well, I've got $1 million that I could just write a check for, and that's pretty rare. I think in the Midwest, if you've got $300,000, $400,000, $500,000, $600,000 in retirement savings and a house, and you get your car paid for, and you don't have any credit card debt, you've done pretty well. And I think that a lot of the people that I see fit that bill. And I do have people that have saved more than that. But I think that for the most part, if you've lived in this area, you probably haven't been making $300,000 or $400,000 a year in salary like you might have been in Silicon Valley or New York City or something like that. And so it's a little bit different mindset for people here. And my dad, always calls this the last bastion of sanity.
Right.
And sometimes I question that sanity, like last weekend with the protests and all the different things that have happened. If you were out and about, you probably saw some of these protests, and which, by the way, I just have to pause and just say, it's very clear that these people don't want to be on these street corners. Somebody is paying them to be there. And we know that there's evidence of the Soros family and empire and other people paying Democrats to go out there and protest. But I mean, it seemed very obvious this last weekend. But anyway, that's neither here nor there. Being in the Midwest, though, we have a different set of values for the most part than on the coasts. So it doesn't take as much money to live here, but at the same time, it takes more than it used to.
Jake, a lot of these people I have found, they save very, very well, but they just can't spend any money. They're great savers, but often nervous spenders. Your dad talks about the story of going to visit a family and, they had significant assets and they were sitting on an old broken down couch. And when he was getting ready to leave, the husband told the wife, well, when Randy leaves, we'll go to Goodwill and see if we can find a new couch here. They're great savers, but often nervous spenders. Why do you think that is?
I think there's a couple of reasons for it. First of all, those people today would be probably in their 80s. If you're in your 80s today, your parents were alive and remember the Great Depression.
Yeah.
And I think there's a lot of that mentality that got passed down to the next generation, that the next generation kind of beat into the heads of their kids. And that's that, you don't throw things away. We try to repurpose things, and there's a balance to everything in life. It's good to be frugal, but at the same time, life is short, and you should do some of the things you want to do while you still have your health and the ability to do those things. And like I said, there's a balance. I have many, many frugal clients like you were describing, Jeff. I have some people that are just terrified to spend a single dollar. They go into retirement and they're still trying to save in retirement, where they're like, well, if you pay me this much money, then I can still save this money in the savings account.
Yeah.
It's like they can't turn that switch off. Obviously, we saved this money for retirement so that you can live in retirement the way you want to. But like you said, some people have a hard time flipping that switch, and that really just speaks to their discipline. I don't think that's a bad thing, but at the same time, just know there's a balance, and it's okay to spend some of these acorns that you socked away over the last 40 years.
Jake, in the past, you have talked about a 5-pillar approach to retirement. Can you walk us through that, and what should people actually have in place?
Yeah, so 5-pillar approach, or 5 things that you want to kind of keep an eye on when it comes to retirement. First one would be taxes. We want to make sure that we don't make any mistakes when we're moving your retirement money around. Make sure you understand the tax consequences of cashing out a pension, making sure it gets rolled over so there's no gotchas or anything. But having a plan for taxes in general. How much tax have you been paying while you're working, and how is that going to be affected whenever you go to retirement? That's a big first one for sure.
All right, so taxes is number 1 with his 5-pillar approach. What would be down the list number 2?
Yeah, I think having your investments lined out, like we talked about earlier in the show, having some money that is going to grow for you for sure, but also having some money that is safe is an important part of that, and making sure that you're not laying awake in bed at night when the market moves 5 or 10%, wondering if you're going to make it. That's no way to live. So having your investment plan set up to where you can take your income and you can make sure that not every little bump is going to derail your retirement, or that you're not going to have to turn off your income in retirement whenever things get bad. That's no way to live. So we need to have an investment plan that will account for that.
So a complete retirement plan ideally should include a plan for taxes, investments, but also income, and that's creating a reliable paycheck. How do you go about doing that, turning investments into income?
Yeah, so there's quite a few ways to do that. It kind of depends on what type of investments that we have. Again, a lot of times there's certain kinds of accounts that are good at paying out income. But the short answer is that we basically set up an income paycheck like a paycheck from work, where it gets direct deposited into your account. We send Uncle Sam his portion before we send it to you, but it just shows up just like a paycheck, so that you don't have to worry about when it's coming or how it's coming, or having to go to the bank and cash the check. It's just very similar to the way you get paid now.
And the fourth part of this 5 pillars here has to do with healthcare. Having a healthcare plan is so important, especially if you're under 65. But if you're over 65 and you've got Medicare, Medicare still doesn't pay for everything, does it?
Right. Yeah. And so if you retire before 65, you obviously have to navigate this nightmare called Obamacare. Hopefully you have an employer plan or something that will allow you to stay on, or you can use COBRA to get you from 63 and a half to 65, or something like that. But yeah, healthcare is probably one of the biggest things keeping people from retiring before 65, because I think if you had a reasonable health insurance plan out there that was somewhat affordable, I think pretty much half the people from 60 to 65 would retire immediately. And that's the only thing really keeping them there. So healthcare cost as you get older definitely becomes more and more, but getting to Medicare at least helps a lot with the day-to-day healthcare costs. Now, obviously, Medicare doesn't cover long-term care and that kind of thing. That's a whole nother discussion. Long-term care can be quite expensive as well. And so making sure that we understand how our portfolio will do if somebody needs a nursing home stay or whatever the case may be. These are all things that we're looking at.
Talking with Jake Floyd, Floyd Financial Group. We're talking about a 5-pillar retirement approach here. Once again, our phone number, 417-889-7233. So, Jake, we talked about taxes, investments, income, and healthcare. Finally, estate planning. Can you walk us through that a little bit, or at least the basic documents that you think everyone should have?
Sure. When it comes to estate planning, we're basically talking about what happens when you're no longer here, who gets your stuff. But we're also talking about trust, will, that kind of thing. Probably the most important thing you need to have, though, is powers of attorney, especially like a durable power of attorney for finance, that kind of thing, where most people's assets in today's world are IRA assets, or they're pre-tax assets. The problem with that is if your spouse becomes unable to make decisions, if you do not have a power of attorney for finance, you will have to go get a court order and probably a conservator and guardianship put in place before you can use that money that your spouse has to pay bills or whatever. So a lot of people find themselves inadvertently in that position if somebody has a car wreck, or if it's later in life, somebody starts to develop dementia or something like that. If you do not have those documents in place, it can be quite the teeth-pulling exercise to be able to just do basic things like pay the bills. So sit down with an estate planning attorney, elder law attorney. My wife Elizabeth does this type of planning, but there's several others in the area. See if you can find one that doesn't charge you to sit down. That would be step one, because I know some of the people in the area charge like $500 just to have a meeting, which is pretty crazy. But if you can find one that'll do a free consultation for you, you can ask your questions. They can ask you some questions maybe you haven't thought to ask, but just having an estate plan in place to distribute things when you're no longer here, but also provide if there's a situation where a spouse can't make decisions or whatever, just having all that in place ahead of time can really smooth things out down the road.
Jake, of course, taxes is a big issue. That surprises a lot of people. It is a big deal for this group in retirement. But let's get practical here about taxes. What are some smart strategies that Midwestern millionaires should be thinking about right now as far as taxes go?
Yeah, I would say probably the number one easy thing that applies probably to the most people listening to this show would be qualified charitable distributions. So pretty much, I would venture to say most of the people listening to the show probably attend church. If you attend church, you're probably tithing. If you're tithing and you are not doing it from an RMD scenario, if you're 73 or older, in some cases a little bit younger, and you're taking RMDs, you can pay that tithe and get it to where it's not taxed credit for you through something called a QCD. That's a big one that people don't know exists. You're tithing anyway. Just tithe it out of your IRA instead and save yourself the tax money. That's an easy one that really makes a lot of sense. That doesn't just pertain to churches, but I'd say most people listening to this show would apply there. But any charity, if you give money that is otherwise an RMD, a required minimum distribution, through a QCD, a qualified charitable distribution, then that money never hits your tax rolls. So that's one. Another one, if it makes sense, would be Roth conversion. So a lot of people that know me know that I'm not a huge fan of Roth conversions, simply because that money you pay in taxes never earns you any more interest. However, if you have kids who are vastly out earning you from maybe you made 60, 70, 80,000 a year during your work time, but you have a kid who's making 250,000 a year or more, sometimes doing a Roth conversion to pay the taxes for them for what they will inherit can make sense, because they're going to be, if they inherit your money, that may put them in the max tax bracket. And now they're paying 30 or 40 cents on the dollar versus you could be converting it 15 cents on the dollar, 17 cents on the dollar. So there are some strategies that can make sense there, but Roth conversion is not a blanket for everybody thing, but it's something we can talk about.
Talking with Jake Floyd, Floyd Financial Group, and we're talking about Midwestern millionaires, or those people who have basically saved or worth $1 million. If you've saved $500,000 or $1 million or more, this is exactly where the game changes. You're no longer just investing, you're making decisions that could cost you tens or even hundreds of thousands of dollars in taxes, fees, and missed opportunities. At Floyd Financial Group, we specialize in helping people just like you. They're what we call Midwestern millionaires. Build a complete retirement strategy across income, taxes, investments, healthcare, and estate planning. Right now, we're offering a complimentary retirement review, no cost, no obligation, no judgment. Will meet you where you are. To get yours, call 417-889-7233. It's 417-889-7233. You've worked 40 years to build your savings. Don't risk getting retirement wrong. Jake, it's time for a break. When we come back here on Show Me the Money, we'll be talking about ways to generate income and how to know what's right for you when Show Me the Money continues here on 104.1 FM, KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about ways to generate retirement income.
And Jake, a lot of people think retirement is just about saving money, enough money, but the real challenge is turning that money into income. Now, there are many different strategies out there. Where do people even start with this problem?
Sure. So understanding how much money you're going to have in retirement is kind of the key to figure out whether it's time to retire, right? The first place this money comes from is your work income, Social Security. Obviously, when you're working, you're going to have probably a retirement plan that you are setting up, that you're funding, that hopefully your company is matching. So the retirement savings and Social Security is kind of the bedrock of most people in the Midwest's retirement plan. So understanding what you're going to get for Social Security, how it's going to be taxed, how much you can take out of your 401k without running out, those are kind of the core elements of an income plan.
So again, the core elements here, going back to work, and the pros to that, certainly not only the paycheck, it can provide purpose and structure in retirement, but the downside is that you're still working. Social Security, of course, the foundation, but it is not the whole plan. What about guaranteed income, Jake? Things like pensions and annuities, where do they fit into this picture?
Yeah, so pensions are largely a thing of the past in the way that we think about them, whether it's a railroad pension or that kind of thing. Pension plans are very expensive. They worked pretty well in the 80s, but they're costly to companies. A lot of big corporations that used to offer them are publicly traded. And because they're costly to companies, the shareholders don't want them. And so pension plans have kind of faded. I think it's like 13% of people or so now have a pension, the last stat I saw. So if you have a pension, that's great. And it's a very good part of an income plan. But for other people, like you said, annuities can be used to create pensions. They can add safety. Depends on the type of annuity. There's quite a few types of annuities out there. We should probably do a segment on that at one point, just all the different types of annuities. But an immediate annuity can be used to create an income stream. Fixed indexed annuities can be used to create income streams while still growing your money, potentially. As well as variable annuities can do that. But variable annuities tend to be very expensive, so I'm not as big a fan of those. But yeah, annuities can be used also to create income streams that we can't outlive.
So, Jake, if someone just has a 401k, as you said, only about 13% of people have pensions, is there a way to create your own pension?
Yes. So like I was saying, if we have a lump sum of money and we want to turn it into an income stream that we can't outlive, we can take that money and put it into a couple of different types of annuities if we wanted to. And they would guarantee that income for as long as we can live. So if you live to be 115 or 108, like Jeff's aunt, it just keeps paying. And people are mystified by that. They're like, how can they keep paying even if I run out of money? Well, that's what we paid them for. Now, whether or not that's the best option for you is another story, because sometimes those plans can be a little rigid. But if we just want the most income possible from the least amount of money put up, annuities can be a good source of that. If we want a little more flexibility, we may or may not want to use that option. But if we just want guaranteed lifetime income, annuities are a good way to get that.
Yeah, and I asked that question because it all comes back to annuities, and a lot of people say, I hate annuities. You ask them why? Well, because they've been told that they should hate annuities.
It's like Donald Trump, right?
Yeah, exactly.
Like, why do you hate Donald Trump? Well,
I don't
really know.
I too.
Kind of the same thing with annuities. It's a 4-letter word with 7 letters in it.
Exactly. But there's several different types of annuities, as you talked about. There are, just your regular annuity. There are fixed annuities. There are variable annuities. There are immediate annuities. There are delayed annuities. So, yes, we will have a discussion about annuities next week to maybe look under the hood and basically just tell you the different types of annuities. Now, there are, I think Randy said there are thousands of different types of annuities. But out of those thousands of different types of annuities, Jake, how many do you actually use?
Yeah, I would say most annuities fall into 4 categories. So there's variable annuities, immediate annuities, fixed annuities, and then hybrids. For me, that kind of encompasses all of them. What he's saying is there's thousands of different contracts that work slightly differently, but they all kind of fall into those 4 categories. So which of those is appropriate really has a lot to do with what your goals are. Some people don't really want any of their money paid to them as income in retirement. They just want to pass it to their kids. That would call for a different type of annuity, or maybe no annuity at all, and a different type of investment strategy. It kind of just depends on the situation. But yeah, there's basically 4 main types of annuities. And like you said, we'll get under the hood of that next time.
Yeah, we'll do this next week. Randy was saying with the thousands of annuities, we use 2 or we use 3. He didn't really explain the different reasons for that.
I was just going to say that, there's 2 or 3 companies right now that we really want to work with. There's probably 80 or 100 carriers out there that offer annuities in today's world, and some of them cannot be trusted, in my opinion. Some of them simply won't pay any money. But there are a handful that are good, and we have a lot of experience in this area and finding the companies that are good to work with and are not going to be trying to take advantage of us. And I can explain more about that next week. We'll get way under the hood. But basically, we want to make sure that we don't just grab the first annuity that we see, and we need to consider who the carrier is. The entity, the company offering the annuity will have a lot to do with how well it performs and whether their guarantees are as good as they sound.
417-889-7233 is our number here. You're listening to Jake Floyd, Floyd Financial Group. If you would like your Floyd Financial Group retirement reviews that could include a discussion about annuities, again, no cost, no obligation. It's 417-889-7233. We can talk about pretty much anything that you bring to the table. And again, it's not going to cost you a dime. There is no judgment. We'll meet you where you are. Once again, that number, 417-889-7233. Let's talk about investments generating income. Jake, this is where a lot of confusion comes in. Can you elaborate?
So, Jeff, I find that when we create plans, the less rigid they are, generally speaking, the better. And what I mean by that is when you retire, you probably have a vision of what your retirement is going to look like and the things that you would do with your time, the long walks you would take with your spouse on your property when you had time to do it, and all the shopping you would do at Target. Wait, hold on. I'm thinking of my wife. No, I'm just kidding. So I think that when you envision retirement, whatever it means to you, it's important to realize that that's probably not how it's going to go, meaning life is uncertainty. It may be better than what you're envisioning, but life can throw you curveballs. Allowing for change in your retirement plan, I think, is a huge deal. And a lot of people's retirement plan does not really allow for change. Either they're tied into a pension or even some of these annuities we were talking about. You know, if we take all our money and dump it into a guaranteed income annuity, what happens if I want to take some more money out and go do something ahead of time and I don't want to wait for all those checks to come in? If that money's tied up in an annuity, you may not be able to do that. So I think it's important to have more than one bucket of money, first of all, so that you have enough of the three things that we're looking for in retirement. Three things are growth, safety, and liquidity. We need to have an adequate amount of those three things in our portfolio. The problem is there is no one investment that does all three of those things well. So the market obviously is good at growing money and it's good at liquidity, meaning you can get to it, but it kind of sucks at safety. Many people are painfully aware listening to this show right now. Markets fluctuate up and down and move around. So in order to get all three of those things, we need at least a couple of different buckets of money, maybe even 3 or 4 buckets of money to get really where you want to go, but at least a couple of different buckets so that we can get enough liquidity and enough safety and otherwise grow the money. And so as we're looking at income sources, whether it's annuities or dividends or real estate income or options or partnership income or mineral rights or whatever it may be, we want to make sure that it really fits how you see retirement going, but also allows for flexibility in case life deals us a different hand than we expect.
Jake, I want to bring up something I think is very important, and I call it the reservoir strategy, the idea of having a backup plan for income. Can you elaborate or explain a little bit more about what I'm talking about here to our listeners?
Yeah, so if your retirement plan allows for it, and if you have saved enough money, it can be a good idea to have a reservoir, if you will, or a pile of money that's dry powder, meaning the rainy day fund, or if markets go down a lot, it can be used to buy when things are on sale. If inflation takes off and you want to have some extra income, we can use that. So we're talking about safe annuities, fixed annuities, CDs, maybe treasuries, maybe some structured products, structured notes, but things that generally are going to be there when you need to go get them. It can be a good idea to have some of that. Now, I will tell you that people in this area tend to like their cash, not necessarily paper cash, although there are some that like that as well, but just having a healthy amount of money either in the checking account or the savings account or the money market or CDs is pretty common around here. And I think that people feel safe at the bank, and that's fine. Just know as an investment advisor, it's not my goal to try to drain you of all of your cash. In fact, I like people to have a good amount of what my dad would call mad money
Yeah.
on the side so that you don't feel like you have to come asking for money every time you need to spend $500 because you've got a healthy amount of savings over there that you can get to. How much is appropriate for that is really dependent on the person. I have some people that really don't feel good unless they got $100,000 in the bank. And that's okay. That's a personal preference. One thing to remember about all this is 100% your money, right? It's not my money. So I will guide you and help you try to avoid the potholes on the retirement road. But at the end of the day, you direct your destiny. I am not going to try to get you to do anything you don't want to do. And my goal is just to bring value to your situation. So whenever we're talking, it's important that I understand what's important to you. So if you've never been in to see me before, you'll find when you come in that I ask a lot of questions that maybe don't seem like they have bearing on investments. And that's because I want to understand what's important to you so that we can tailor the plan around getting you to where you want to be in retirement.
And Jake, earlier we talked about the Midwestern mentality. We were talking about dry powder here, and that's something that we say here in the Midwest or in the Ozarks, and I was just thinking about that. It's a little outdated. I mean, they had powder when they were using muskets, so you can say I've got dry powder, or if you're a modern person like you and me, Jake, and we like to shoot guns, we'll call it an extra mag with,
there you go.
with
I like that.
With having some surplus nines in there. Okay.
Maybe a few extra mags.
That's right. Few extra mags. That is what we're talking about here. Here's the reality. If you're within 5 to 10 years of retirement or already retired, this is where mistakes can get expensive. Choosing the wrong income strategy or the wrong combination can cost you tens of thousands of dollars over time. Floyd Financial Group, we're here to help people build a complete retirement income plan, not just investments, but income, taxes, risk, and distribution working together. Right now, we're offering a complimentary Floyd Financial Group retirement review. To get yours, it's 417-889-7233. You've spent decades building your savings. Now let's make sure it pays you back the right way. 417-889-7233 is the number to call. You can also find out more about us online at floydfinancialgroup.com. Jake, let's take a break. When we come back, we'll wrap it up by talking about 5 things that people wish they knew before they retired when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about 5 things people wish they knew before they retired.
And Jake, a lot of people spend decades planning for retirement, but once they actually get there, they realize that there were some things that they didn't fully understand. And today we're talking about 5 things that people wish they knew before they retired. And honestly, this could save someone years of stress. So let's start with something a lot of people overlook. It's getting the right financial advice. Why is this such a big deal and so difficult to come across?
Yeah, I think that the value of good advice is probably the biggest thing people overlook. And I think there's a lot of people that delay planning their retirement because they don't really know where to start. And everybody around the water cooler is an expert. You know, did you hear last week Joe Bob, he retired and he made $1 million in the stock market? And that may or may not be true, let's say, number one. But number two, asking your coworker who's a welder about retirement, he may be a great guy, may be a smart guy. I love welders. I think welding is a great profession that's going to be around a long time.
Yeah.
But it is not a retirement type of profession, right? It's important to make sure that you get good counsel, but from somebody who actually knows what they're talking about. Because we live in the world where, well, Google told me to do this and Google told me to do that, right? I Googled, how much do I need to have saved for retirement? And Google says that I need to have $5 million, and I don't have $5 million. Well, Google probably is assuming that everybody lives in Silicon Valley because that's where Google lives. So it's important to get good advice from somebody that you trust. And some of that is just going out and finding and building some relationships. Sometimes I have people come see me that are 40 years old, and they're like, hey, I just want to start this conversation. I want you to take a look at what I'm doing and tell me, what am I missing? What should I be doing? What are the questions I'm not asking? And I love to, I donate my time in a lot of cases to those meetings, and that's okay, because I want to bring value to people's situations. And sometimes there's things I can help them with, sometimes there's not, but there's almost always some bit of advice that I can give that will make a difference for them over the next 20, 30, 40 years. And I really enjoy doing that. So a lot of people rely on workplace 401k reps or a friend's recommendation, which can be good, but it can also be dangerous. And so talking to somebody who knows what they're talking about, even if you don't do business with them, it's okay to ask for advice and build some relationships that can help you down the road.
So I think the first thing that people wish they knew before they retired is the value of good advice. And of course, we give it here at Floyd Financial Group, 417-889-7233, if you'd like to just chat with us here. Second one is you don't need a big income to start. A lot of listeners probably feel like they didn't make enough money early on to really save. Is that a mistake thinking that way, Jake?
Yeah, I mean, some is better than none. I think there's a lot of people, probably the biggest misconception with income and saving for retirement is, well, when I get that next raise, then I'll have enough income to start saving. And the problem with that is you will always learn to live at the limits of your means. You will buy things or you will upgrade your vehicle or whatever to fill the amount of money that you have. If you learn early on to live without 10% of your money, and really probably 20% of your money, because 10 should go to your tithe, and
Right.
then 10% should go to your retirement place, right? If you learn that early on, you'll never miss that money, and you won't learn to live on it. Trying to go back and carve it out later is actually much more difficult. So one of the ways, if you haven't done this yet and you're looking to do this, the next time you get a raise, if you get like a 4% raise or something, increase your contribution to your 401k 4% so that you don't learn to live on that money. And then you just start saving it. If you do that over the next few years, before you know it, you'll be at 10%, 12%, 15%, and you'll really be saving a lot of money. And that will stack up pretty quickly toward retirement. And we always want to make sure we're getting the match, too, out of our employers. Whatever they're willing to match, we want to at least be getting that because that's free money.
So the second thing that people wish they knew before they're retired is that you don't need a big income to start. The key here, as Zig Ziglar once said, is all lights don't have to be on green before you head to town. You've got to start some way, and even if it's $1, $2, $5, if it's 2-3%, you got to start somewhere. The most important thing is just to start and be consistent with it. Next one is catch-up contributions. Let's talk about people in their 50s, Jake. A lot of folks feel behind. Is there still time to fix this problem?
There definitely is, and catch-up contributions are one of the ways you can do that. So for IRAs, you can contribute a little bit more, but inside of a 401k plan, you can contribute a lot more when it comes to catch-up. So before age 50, I think the limit right now is, it changes every year, but it's around $23,000-24,000 a year. Once you get to retirement age, depending on how old we're talking, when you get beyond 50, it's one level. When you get beyond 62, there's another level. But you can contribute $32,000, $33,000. You're allowed to save quite a bit of money. And there's a lot of people that do it this way because they're raising kids. And then by the time they hit 50 or 55, those kids are raised and gone. And now they can afford to really sock some money away because they're not spending it on the kiddos. So there's a lot of people that start the retirement savings journey at 45 or 50, which is not necessarily advisable, but it's not too late. And really getting some contributions in there while you still have time left. Every second counts, every dollar counts. But it's never too late to start. The sooner you start, the better, but it's never too late to get started.
Jake, this is one that people don't think about a lot, and that is insurance. What do retirees get wrong about insurance?
So there's quite a few things, I would say. A lot of people don't realize just how much they're paying for their health insurance. There's a lot of people that when they retire, they choose to take their workplace insurance with them, not understanding how it works, not understanding what it costs, and the fact that they were paying a fraction of it when they were working there, and now it's 5 times as much cost because the employer's no longer contributing. Insurance is not an investment necessarily, right? And life insurance specifically, most plans you have to die to get it. So that's not a retirement plan if you're wanting to use it while you're living. There's strength in simplicity. A lot of insurance policies and things can get very complicated very quickly. We want to make sure that we're not just insurance rich for the sake of being insurance rich. That's not necessarily a good thing. It's not necessarily a bad thing either, but you can go broke paying for insurance on life insurance and workers' comp and all kinds of things if you're not careful, especially when you go to retire. If you start trying to figure out how to pay for health insurance, you take your life insurance policies with you and everything. So it's good to have somebody to bounce these off of and say, hey, do I really need this? And if I do, should I take this policy or should we look at doing a different policy? And that's something we can help with as we go through that retirement journey.
And Jake, the fifth thing that people wish they knew before they retired has to do with estate planning. Why is this so critical?
I think there's a lot of people that put off estate planning thinking, well, I'm 20 years old. I don't need to do estate planning. I'm not going anywhere. And then a decade later, I'm 30 years old. I still got time. I'm 40, I'm 50, I'm 60. Pretty soon you're saying I'm 70. I still got time. And nobody's guaranteed tomorrow. Nobody's guaranteed their health tomorrow. And so if you're not careful, you can put it off until you can't really put it off anymore. And then you're in crisis mode. And depending on the crisis, you may not be able to do it at that point. So I think taking a moment to think about how you want things to go, taking a moment and maybe a little bit of money to talk to a professional, whether it's an estate planning attorney or even starting in a financial planner and kind of asking them some of the basic questions and say, okay, what do I need and what's frivolous? What should I spend money on here? How much is too much money? How can I make it go as smoothly as possible when I'm no longer here for my spouse, for my kids? How can I avoid probate? How can I avoid spending my life savings in a nursing home? Those types of questions, just to get the ball rolling. Once you get the ball rolling, you'll find that, it's not too difficult to get the planning done, but sometimes it can be ominous to get started.
Jake, when you step back and look at these 5 things that we've talked about here, it really comes down to having a plan, not just hoping that things work out. As I've said, hope is not a plan. Retirement success isn't accidental. It's coordinated. It's putting together investments and taxes, income, risks, and estate planning. If you're within 5 to 10 years of retirement or already retired, this is where mistakes can get expensive and sometimes irreversible. That's why Jake and the team here at Floyd Financial Group are offering a complimentary Floyd Financial Group retirement review. They'll walk you through whether you're paying unnecessary fees, if your income plan is actually sustainable, and are there tax mistakes that are hiding in your portfolio right now. This isn't a sales pitch. It's a real second opinion on your retirement. If you'd like yours, call 417-889-7233. You can do it right now. 417-889-7233 or visit FloydFinancialGroup.com and get your plan dialed in before small mistakes turn into big problems. Well, Jake, we just get started and time is running out. That's the case right now. So for Jake Floyd, I'm Jeff Shade. Thank you so much for your time. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.